Thank you. Thank you very much. I like the image of the subject of tonight's lecture being an examination of a marriage relationship between society and banks. I'll pick up on that theme to get this started. Maybe in a sentence, the talk will be about banks have been doing something for a long time that we haven't really been paying attention to that much as economists. And maybe what they've been doing has been getting us into trouble, so we should take a look at the relationship over a long time period and think about what it is they've been doing. So let me move into that. About 10 years ago this month, really, or really beginning of August, the global financial crisis got started with trouble in money markets. And it looked like a development that was, say, not familiar to macroeconomists. With the firms that were getting in trouble were securities firms. So Bear Stearns in particular fails in the spring of 2008. And then in the fall of 2008, of course, Lehman Brothers fails. And AIG, an insurance company, has a derivatives arm that fails. And somehow this turns into a crisis that, as Ben Bernanke explained in later testimony, brought the US and perhaps the worldwide financial system to the brink of a total collapse. That's a quote he gave in his testimony. And to many practicing macroeconomists who would aspire to offer useful advice about the regulation of banks, this seemed unfamiliar. This is not something that we talked about in our day-to-day theorizing or empirical work. So my motivation for taking a historical perspective is that as I've had time to kind of look over, and I will say this will be focused on US financial history, if you go back a ways, this relationship between banks and securities markets in financial crises is not unfamiliar in US financial history. In fact, I think it was central to the history of what we called the national banking era, which started with our Civil War in the 1860s and carried through to the foundation of our central bank, the Federal Reserve, in 1914, and even continued through 1929. And so to an economist of that time, this type of crisis might have seemed quite familiar. So that's kind of one first point I'll want to make in the data. And I think it'll be useful to spend a very brief time revisiting some of the ideas for how to address that relationship between banks and securities markets that participants had for regulatory change at the time. Some of the ideas that we're discussing now have been tried in the past without great success. So that'll be a second point that I'll want to make. And there are ideas that were implemented in the 1930s that are not being fully discussed now, we might want to discuss. So a second point I would say is that this history might temper enthusiasm for a regulatory quick fix. But the last point is kind of more important for economists, practicing economists. If we're to be useful in shaping the regulatory debate, we'll want to guide a regulatory cost-benefit analysis. So we'll want to have a framework where we can say, on the one hand, how does an active and free banking system benefit the economy? And on the other hand, what would be the costs of constraining some parts of their behavior? I would say that the current state of affairs in the regulatory debate is really centered on a model of banking that only captures one side of what they do, which is kind of the standard model you'd teach in an undergraduate class, would have banks issuing liabilities that have some money-like aspect, so they perform a role there, and then using that funding to provide finance for non-financial firms and households. But a large portion of what they've done in history and what they've done recently is a second form of lending that I'll broadly term lending for speculation. They're financing activities in securities markets. And kind of the most important theme for my talk, and something that I myself will only speculate about, but hopefully economic research people here and elsewhere can kind of push this forward, is to begin to flesh out models of what that lending activity is facilitating, what contribution is being facilitated to society. It's not the invention of chai lattes, but the invention of kind of portfolio strategies. And that, coming up with a model of that, I think will be central for conducting any kind of cost-benefit analysis for this type of regulation. So in my talk, kind of the most important point will be to conclude with some speculation of what models of that activity might look like. Okay, so the outline of the talk, I first have to tell you what I have in mind when I say the words lending for speculation. What is this activity? I'll give something of a definition, and then we'll go through a bit of history about the US financial system after our Civil War, through the crash of 1929, when we had frequent financial crises and a gradual regulatory response that led eventually to the elimination of this activity from our financial system in what we would call a quiet period, where we did not have crises, and we had a pretty simple financial system through the mid-1980s. And then this activity of lending for speculation started to come back and grew to be quite large, peaking at the end of the second quarter of 2007. And then we'll trace how it's come down a bit after the crisis. And then we'll get to the part for economists is like, so what should we think is going on with this activity, this lending for speculation? What's the model we might use? And then just some brief thoughts on regulation going forward. All right, so first, what is lending for speculation? It's an activity that's been around for a long time, principally in the United Kingdom, United States, where you have very active securities markets. And I'll show you a paragraph from a book I found very helpful in understanding this activity called The Law and Practice of the Stock Exchange, about the London Stock Exchange. So London should have been in parentheses. From 1897, this book got into the nitty-gritty of what happens when you have defaults and things like that, but it has an entire chapter titled The Mortgaging of Securities. And this paragraph is from the introduction of the chapter. So the first part of this paragraph, the first sentence, really captures the essence of what lending for speculation is. It seems to be people participating in securities markets will offer up their securities as collateral for loans of cash. They'll also do the reverse. They'll offer up cash as collateral for loans of securities. So if we want to boil down what the transaction is, what we have is two parties. One has cash, one has a security. They swap those cash and securities at one date, and then they undo the swap at a later date. And the labeling of which one is collateral and what's being lent will depend a bit on the motivations behind the transaction, but mechanically, that's what's going on. Now, the rest of the paragraph emphasizes the theme that among members of the stock exchange, these transactions are very informally conducted. And I included that here because that's actually one of the things that makes this activity difficult to regulate is that, all the way through when Lehman failed, regulators were shocked at what a mess a lot of the transactions were and how difficult it was to undo the bankruptcy estate. So it seems there's this tradition of kind of doing this on the fast and loose without really a good record keeping that makes the failure of these transactions or the default of a broker often just from an accounting perspective, very messy. So I was just amused that that's a problem that's at least 120 years old, that record keeping is not so well done. Okay, in modern terms, if you were to look at the balance sheet of a large bank holding company, you'll see terms like brokerage receivables, brokerage payables, receivables from customers, payables to customers, repo, reverse repo, securities borrowing, securities lending. These are all names for collateralized security finance. And on the balance sheet of a JP Morgan Chase, that might be a third of what's on the balance sheet, and that's not a full representation of the size of this activity because derivatives are not on the balance sheet, and there's a bunch of netting of these transactions in the accounting. But it does take a bit of detective work to find all this stuff in the footnotes to the accounts. But these are the main categories of this activity. My understanding is that there's a firm in Wellington called Leveraged Equities Finance Limited, founded in 1994, to provide the finance to stockbrokers who are here in New Zealand for you all to buy stocks on margin. So if you wanted to take a levered bet on something, they'll make you a loan, and through your stockbroker, you'll offer the stock as collateral, and off you go. This is not a very big activity here. It's a big activity in London and New York. It was also a big activity in the late 1800s in the United States. And by way of background, we were different than many other countries in that by design we had a fragmented banking system. So our banking system was not in a position to offer finance to big enterprises like railroads and the big industrial enterprises that came up in the latter part of the 19th century. So they turned to the capital market in New York for financing. And you'd have a lot of railroad bonds initially that were issued, and then eventually industrial bonds. And this was kind of a wild time. We were an emerging economy. And to give a kind of a perspective on the background of investing at this time, this is a graph from a 2011 paper. The authors are here. Francis Longstaff is a colleague at UCLA. That's just showing the default rate, value-weighted default rate on bonds that they could find traded on the New York Stock Exchange, and then later using, I think, Moody's data. From the late 1800s through the 2001 series of defaults, if you kept the data going through to the 2008 crisis, actually the default rate is not much different than it was in 2001. But the point I want to make is back here when the US was booming and railroads were being financed, you see very high default rates even in comparison to the Great Depression. So this was a wild time to be investing. Even though you're investing in bonds, it much had an equity-like feel to it. And so taking a levered bet on this could be exciting. At the same time, the banking system, as I said, was fragmented, and the primary form of regulation was a liquidity standard, a reserve ratio. So the banks were often restricted to be a single branch, or they couldn't cross state lines. They had to hold a certain fraction of their deposits as currency or treasury securities. But to kind of mitigate the impact of the standards, the country banks were allowed to hold some portion of their reserves as interbank deposits in cities like St. Louis and Chicago. And those banks were allowed to hold a portion of their reserve as interbank deposits in New York. And so the New York center banks had a problem or a challenge. What do we do with all these interbank deposits? And so what they did was lent them to people who wanted to take levered bets on securities in the New York Stock Exchange, which was primarily railroad bonds. So you would have the banking system linked to securities markets through what was called the call money market. And a typical financial crisis of that era would start in New York. Some news would come out that we're going to see one of these, people would think we're going to have a lot of these defaults. Bond prices would crash. Maybe Jay Cook or some other important securities firm would call suspend. Banks in the countryside would be concerned about getting their interbank deposits back, so they would start pulling their reserves out of this pyramid, and you would have a run on New York center banks, much like we saw a run on money market mutual funds in 2008. money market rates would spike, you would call in the loans that had financed this, you'd have forced selling of bonds, and depending on how things went, you might have a spread then of trouble through the banking system around the country. So this had a bit of a feeling of, in 2008, we see Lehman Brothers fail, mortgage-backed securities seem to be toxic, let's just get our cash out of this system. And that would lead to a lot of panic selling and a concern about bank failures. Now, the regulatory response at the time, we are going to implement liquidity standards. The regulatory response at the time was that the liquidity standards were not helpful. What they said, our problem is they're too rigid. Banks are responding to them by hoarding liquidity in a crisis. We need a central bank to mitigate this. But equally important, we need to change the nature of the relationship between banks and securities markets. A debate was between real bills versus speculative credit or margin loans. And in particular, in the United States, after the panic of 1907, we looked at the financial arrangement in the United Kingdom, where the interbank, the money market was much more dependent on something that looks like non-financial commercial paper. So this feature of lending into the stock market was much more prevalent in the United States, whereas the real bills, which would be 30 or 60-day paper from non-financial firms, was much more the core of the money market in the UK. And in the US, we said, we need that. We need a central bank, and we need to change the money market. I'll say later, we didn't talk about capital standards. That was not something that was discussed. That's kind of new. We're putting a lot of faith in it. We'll come back. I might have a question about how useful that would be. Okay, so in this effort, in 1914, we set up a central bank, the Federal Reserve, and in this effort to change the relationship between banks and securities markets, people designing the central bank said, let's give a gentle nudge to the system. What we'll do is set up the Federal Reserve Act, so the Federal Reserve, as the central bank, will not take at the discount window, as it says there, notes, drafts, or bills covering merely investments or issued or drawn for the purpose of carrying or trading in stocks, bonds, or other investment securities. So what they wanted to do was push the banks to use non-financial, something like non-financial commercial paper in the money market, because the Fed would accept that at the discount window, and push them away from lending into the stock market. Okay, but I call it a gentle nudge because the idea was, well, if we make this policy at the central bank, then the money market will follow suit. It didn't. The call money market thrived after the founding of the Fed, and we'll now get our first data, because once we have a central bank, we can actually get data on the scale of this activity. And we had kind of a dramatic up and down of this activity in the stock market boom and crash around 1929. So the data here are data on the scale of this lending into the stock market. The horizontal axis is dates from 1918 through 1938. The vertical axis is billions of dollars. To give you a sense of scale, in 1929, nominal GDP was a little over $100 billion. So roughly speaking, in 1929, this is percentage points of GDP. Now, there's three lines here. The red line and the green line are coming from regulatory reports by banks saying, how much of your loan portfolio is loans secured by securities? And you see that that really doesn't rise very much. The red line is what's being done by the New York money center banks. The green line is the total from banks reporting to the Federal Reserve. So the difference between the red line and the green line would be banks, say, in Chicago or St. Louis again, just going directly into the call money market. Now the blue line is from a different data source. You can see it looks quite different than these other two. The blue line is the New York Stock Exchange asking its member brokers, of which there are 4,000 or 5,000, what is the extent of your borrowing in the call money market to finance margin loans to your customers? And you can see the stock market in the background. The stock market is, rocketing up in the late 1920s. And a lot of this enthusiasm of investing in stocks is, going along with a huge increase, a factor of 3 or 4 increase in the scale of margin lending. And you might ask, okay, who's doing this lending if it's not the banks? This activity was so exciting that non-financial corporates like Standard Oil, Rockefeller Standard Oil, would take their cash and invest that directly into the call money market, bypassing the banking system. It would go to a broker who would make a margin loan to a customer. So even though the Fed was trying to discourage this activity, this went around the banking system, and directly, a pool of cash was now going directly into the stock market through these brokers. And then, of course, in October of 1929, the stock market crashes, and all these non-financial firms call their margin loans back. These are callable every day, so you have forced selling, all the dramatic images of the crash of 1929. And the New York Times is reporting on these data on its front page in real time. So this is very much in the minds of people watching developments at the time. And by the time we get to the early 1930s, when we're redesigning the financial system, those in charge had come to the conclusion we've got to get rid of this activity. That this exposure, this lending in, is just too volatile. And so there's 2 acts in the early 1930s that are aimed at really shutting this activity down. We have the one Americans are all familiar with. We talk about the GlassSteagall Act, which is the separation of commercial and investment banking. As part of that, commercial banks are not allowed to be involved in loans to brokers and dealers except to finance investment in US Treasuries. So that was an exception that still is around. But perhaps more important for what we're discussing is the act that sets up the securities, the SEC, gave the Federal Reserve broad powers to regulate all speculative credit, no matter who was engaged in it. And the Pecora Commission, which was a commission kind of driving the creation of this regulatory structure in Congress, discussed the first point here was to try to discourage this flow of funding from the banking system into securities markets. But this one I found more interesting. It's almost a moral statement. They wanted the Federal Reserve to have the power to reduce the aggregate amount of the nation's credit resources, which can be directed by speculation into the stock market and away from commerce and industry. So Regulation T was how that was implemented, but the Fed was kind of given the charge, let's really get rid of this activity. All right, and so then obviously we have a Great Depression, a world financial system breaks down, we have World War II, we come out, countries look very different than they do now in the sense of there's essentially no international capital flows, so that's an important change in the system. But it was a very quiet period in American finance. It was a period where investment banking was a fee-for-service business. You thought of them like accountants. They would help you. One would help you do your accounts, one would help you issue a bond in the capital markets. You would pay them a fee. The failure of a firm like Lehman Brothers would have been like shutting the lights out for Arthur Andersen after the Enron scandal. Send them home, maybe they get jobs somewhere else, but it's not something that was going to have repercussions in the rest of the financial system. So we see this in the data. We now have a regulatory structure that, separate for deposit-taking institutions and security broker-dealers. So we can see in the data that depository institutions, your standard commercial bank, has liquid deposits, doing non-financial corporate finance and household finance, have total assets relative to GDP, stable from early 1950s. I've arbitrarily cut it off at 1985. Rising from 60% to 80% of GDP, not much ups and downs. We do have a savings and loan crisis. We could talk about that in the question period, but it was not like these previous links with securities markets. And in contrast, security broker dealers are reporting total assets on the order of 1% of GDP. So, and they really don't have much going on. It only begins to climb in the 1980s. Now, when we go to the kind of what's happened since the 1980s, even though we got rid of GlassSteagall, so now JP Morgan or Citigroup will have a securities broker dealer in it and a deposit-taking institution in it, the regulators are able to take those parts of those firms, those separate parts apart because they still have the pre-GlassSteagall regulatory reporting structure. And so we can continue the graphs from 1986 to now. We still see bank depository institution assets over GDP quite stable. There's actually a jump up of 10%. During the 2008 crisis, instead of running away from banks, people ran to put their money into banks because it had the FDIC insurance. But the dramatic difference is for the security broker dealers. So we saw that for this several decades, they would be these fee-for-service firms. They would have assets of 1 or 2% of GDP. And then, I don't know if anybody's read Michael Lewis's Liar's Poker, but kind of with it's a fun book to read about investment banking. But starting in the early 80s, particularly at Salomon Brothers, trading really took over the securities business. And it generated all the revenue, and it's what made all the people rich. And along with that, you see this big growth in security broker-dealer assets relative to GDP, getting up to 50% of GDP at the end of the second quarter of 2007. Then, with that trouble between August 2007 and September 2008, it comes down a bit. And then we have an episode that looks a bit like the crash of '29, a dramatic drop in their assets, and then a continued dribbling down in the post-crisis period. Okay, so this is a graph of their total assets. There could be a lot of things on here, like mortgage-backed securities could be on here. If you ask a firm like Goldman Sachs, what are you contributing to society? One of the things that they'll say is, well, we make markets. We need to hold an inventory of securities, and so that we can, buyers and sellers don't show up in the same instant. We maintain an inventory as a dealer. We add to the liquidity of markets, so we do wonderful things that way. So I want to break down the balance sheet a little bit and think about the parts that we would have easier time analyzing, where they would have assets of cash and maybe an inventory of securities that they were holding as a dealer or that they were investing in for their own account. They'll have equity. They will sell some of the securities short, so they'll have a gross security position and a net one. And then they'll have this other, what I'll call customer or client-facing activities, where they're providing collateralized finance on the asset and liability side of their balance sheet for someone else. They're facilitating levered bets taken by someone else in securities markets. So then we want to talk a little bit about this and who's involved in that. So let's first start by looking at the data on this part of the balance sheet. Do they actually maintain large inventories of securities? So this is from the flow of funds from the mid-1980s through now. Relative to GDP, the gross securities on the balance sheet on the asset side, and the net, which is the gross less the short positions. And you can see, yes, they did double or triple the inventory of securities, and they have come down in the crisis. But just in terms of total magnitude, that's not explaining most of the movement in the balance sheet. Most of the movement in the balance sheet is coming from these items in blue. And if you take what's on the asset side and the liability side, So I'm now showing both the assets and liabilities in those categories in blue. You get a picture of a securities broker dealer. I like to think of it as like a conduit or a pipe. So what they're doing is they're taking cash from one set of parties and securities from another, facilitating this swap between these parties and then undoing it at a later date. And because they're standing in the middle of this swap of cash and securities, they'll have a matching entry on the asset and the liability side of their balance sheet. Now, they don't, a perfectly matched book would be transaction by transaction, but roughly speaking, they have matched assets and liabilities relative to GDP in these categories. So it would be like the brokers on the New York Stock Exchange in the crash of 1929. They themselves were not taking big positions. They were simply intermediating finance for clients. So if we push on this issue of what's the economics of this activity, we have to ask the question, well, who's doing the investing that they're facilitating? Who's behind that? Okay, so it's actually, we don't really know. We don't have such great data on it. I heard that New Zealand banks are participating in bets on the New Zealand yield curve. They might be getting some of this finance. But the picture that we have in the data that's come up since the crisis is that on the one hand, you have investors in money market mutual funds who were kind of like those New York money center banks who were taking in institutional cash and looking for a place to park it to get a bit of an interest rate. And they would be investing in, say, the repurchase agreements of securities broker dealers. On the other side, your mutual funds or institutional asset managers who are not allowed to take levered positions want to get a little bit of extra return, so they'll lend the securities out in the mutual fund to a security broker dealer who has a client who wishes to sell that security short. And they need to borrow the security to sell it short, and they'll pay you some interest for that transaction. And so a mutual fund will be getting some fees by lending its securities out. So these are participants that we have some data on because they have to report their activities. More recently, starting in 2013, the SEC has been getting data on hedge funds and has been getting relatively comprehensive data so they can get into the Cayman Islands and some of the other offshore places. And they've been able to ask the hedge funds, how much are you borrowing for your portfolios? And they're borrowing, the larger hedge funds from which they're collecting data are borrowing now about $2 trillion, which comes close to matching the amounts that we had on the asset side of lending from the securities broker dealers. So now we can say this conduit is financing levered bets being taken largely in the Cayman Islands by hedge funds. Okay, and we'll talk a little bit about, well, hedge funds are again just another financial intermediary. You have to ask the question, who's investing in hedge funds and what are we getting out of it? But before we go there, let's just speculate a little bit about maybe the economics of this transaction. How might you begin to think about what society might benefit from having one party finance a levered bet by another party in securities markets? Why would this be a good thing? Could we put a number on that social benefit? So I think in terms of, if you kind of press me to do it, I would go back to an old style model of optimal portfolio theory and the two-fund theorem and the optimal risk sharing between risk-averse and risk-tolerant investors, and I'll show you what I mean by that in a second. That has a bit of a problem matching the data, that it will make certain predictions I'll mention that don't look like what hedge funds are doing. There'll be another class of theories where you'll have investors who have different beliefs or information about individual securities, and they will want to act on their beliefs or information by taking a levered bet or a short position on specific securities. Okay, so these will be what I would call the two main classes of theories out there, but let's kind of think about their implications. So if you were to teach undergraduates or master's students about optimal portfolio theory, you go back to the work of Harry Markowitz, and we just think about any portfolio you might purchase is going to have some expected return and some standard deviation of returns. And so any portfolio you might purchase would be some dot in this space. And you like to get a high expected return and a low standard deviation of return. So you'd like to kind of move in this direction if you can get there. And in that theory, you conjecture that there's a fundamental set of underlying assets. And you can take a portfolio would be a combination of those assets. And there'll be some frontier here of combinations of expected returns and standard deviation of returns that you can get by mixing those assets. So this has a quadratic shape. And then if you add the possibility of a riskless loan, then investors can actually get combinations here. This would be the riskless interest rate along this line. This is called the tangent portfolio. And the two-fund theorem is that investors should hold only combinations of the riskless asset and the tangent portfolio of risky assets. And if you were risk tolerant, an aggressive investor or a hedge fund, you would choose a portfolio out here which has a high expected return and a high standard deviation. A conservative investor would take a lower expected return and a lower standard deviation. This line is your trade-off. But the way this is financed in general equilibrium is that this investor believes that he or she is holding a cash by making a loan to this investor to take the levered position in this tangent portfolio. So you would imagine a security broker dealer is sitting between these two investors and swapping cash and then securities held as collateral to basically have this investor make a loan to that investor. And it's a very simple theory, and the social gain is that we've improved risk sharing. And if we tried to prevent these transactions, we would be forcing the conservative investor to move here and the aggressive investor to move there, and they both would be worse off. And in general equilibrium, there would probably be some movement in risk premia, so you would see something happen to risk premia if you started to interfere with these transactions. And you could probably put a number on it. I mean, if you push the theory harder, what would be the cost of banning these transactions? Okay. If you go to theories based on differences in information or beliefs, it's a bit harder. I mean, there's this whole parallel debate about the benefits of active investing versus passive investing just by an index fund. That debate, the index fund logic is based on the idea that investing in individual assets is a zero-sum game. One person's going to win, somebody else is going to lose. So if you base it on differences in information, the transaction is really the uninformed investor is losing relative to the informed investor. It can be a very privately profitable activity, but absent general equilibrium effects, this is going to likely be a zero-sum game. And so you might be driven to a cost-benefit analysis that this is an activity that we'd want to severely curtail. It's not something that has general benefits, but it is quite profitable for those involved. So here's some thoughts on regulation that might come from this framework and when I look at this particular history. The first has to do with breaking up big banks. It's hard for me to think, well, I'll go through them. Breaking up big banks, I'll talk about capital standards, liquidity standards, what I'll call universal regulations on lending for speculation, and then finally wrap it up. Okay. So two things about breaking up big banks. The first is, for much of US history, there were no big financial firms, and yet we had these crises, and the dynamics were kind of very similar. So it's not immediately obvious that the size of an individual financial institution is the core of the problem. Now, we do have something very new in modern securities markets. Back in 1929, you'd have 4,000 or 5,000 brokerage firms, members of the New York Stock Exchange, none of them dominating activity. In over-the-counter markets, you have a handful of firms that are dominating the activity. And we do have to ask, what are the returns to scale, if there are any, that would make it so socially advantageous to have a few very large actors now dominating in securities markets. That, I think, is an important area for research, because I think that'll be the main debate about breaking up the big banks, is what damage would you do to the over-the-counter markets if you did so. I think exchanges, historically, you would say would work fine if you had no large securities firms or banks running them. All right, capital standards. For much of this time period, the discussion of capital standards is very new. It really starts in the 1980s. We're putting a lot of faith now in modern regulation that if we just have a high enough capital standard, then we won't have these financial crises. I'm skeptical of that, in part because, the way historically in the United States we dealt with this problem of maintaining the incentives of the owners of banks not to take too much risk is we didn't give them limited liability. So your limited liability for non-financial firms starts coming in the 1830s. And all the way through into the 1930s, it was not standard for a banker to have limited liability. The shareholders would have often double liability. And it was common that when you had a bank failure, they would actually go after the shareholders to recover the par value in addition. And a considerable portion of depositor losses were recovered through this mechanism over this time period. So if that didn't work in preventing financial crisis, I'm not sure why capital standards are going to work. The other thing that I am concerned about is the capital standards that were imposed in the 1980s were imposed on banks with the idea that they should not fail. Like when we do a stress test now, the goal is that we want a bank to go through a stress scenario without having to liquidate its portfolio and without failing. There was a parallel regime for regulating securities firms before we put them together into banks that also had capital standards, but with a different philosophy. The philosophy was we should expect securities firms to fail. They have a bunch of liquid assets on both sides of their balance sheet. The way you deal with a failure is to liquidate the firm, and the appropriate amount of capital is the amount of capital needed to make sure that if you liquidated the firm within 30 days, the customers with brokerage accounts wouldn't lose money. So my concern is we're now moving to a world, we've put the large securities firms under the rubric of this old banking philosophy about capital standards. So we've essentially ruled out the failure of any significant financial firm. And when you think about industrial organization in any industry, kind of ruling out failure doesn't seem like a good idea. We may want to go back to the logic that we had for securities firms before. Liquidity standards. Liquidity standards, in some sense, moving halfway to what people call narrow banking. So narrow banking is a requirement that if you want to issue a money-like liability, a demand deposit, then you have to have only, say, government securities on the asset side. We're kind of pushing money market mutual funds into that direction. The reason I don't think narrow banking is going to work is because if I go back to this picture and we think about the incentives of the aggressive investor, that investor is eager to take a levered bet and is going to pay for it and will start outbidding a narrow bank for financing. So what do I mean by outbidding a narrow bank? If you teach undergrads like an advanced problem of optimal portfolio theory is, what if you start putting a wedge between the borrowing and lending rate? What do the portfolios look like? And I took this picture off the web. You show your undergrads a picture like this. They can no longer borrow and lend with each other, and the conservative investor and the aggressive investor get pushed onto portfolios that are on this curved surface. These lines here you can think of as the shadow interest rates that they're interested in if I were to lend money, that's the shadow rate at which I would lend. If this one were to borrow money, that's the shadow rate at which they would borrow. So a conservative investor can buy treasury securities if they're in positive supply and hold that in their portfolio. But the aggressive investor will try to find a way. It's got this shadow rate they're willing to pay. They can try to find a way to outbid essentially treasury securities. So you'll try to find some way to get around the regulatory system to finance this aggressive investor to start moving out along this line to take a levered bet. And so I'm worried that if the system is focused on regulating the conduit or the intermediary that's facilitating this activity, they won't get rid of the desire to take it and we'll just go around the system, kind of like what we saw in 1929. Okay, so I'll wrap it up with just a brief discussion of, well then, who's so excited about taking these levered bets? I mean, to me, one of the puzzles, we go back to 1918, we have long time periods where there's very little of this activity going on, and then we have time periods where this activity is very big. And so any kind of fully fleshed out theory would have to explain, well, why is this activity so small sometimes and large other times? I had the privilege of being able to give a short presentation of this talk to Larry Fink, who's the founder of BlackRock, which for those who don't know, he's a UCLA graduate, but it's the world's largest asset management firm. And he's done a lot to transform finance by founding this firm and leading to the growth of the asset management industry. And so when I showed him some of these graphs and I asked, well, what is his view of why lending for speculation started to take off in the 1980s, he said it was ERISA, which is a US law that reshaped pension finance. And without getting into details, the basic idea is we created a class through reshaping pension finance of institutional investors, large pools of institutional money that a hedge fund could go to and very quickly raise a large sum to be invested. And the fiduciary standard for those managers of those institutional pools allowed them to participate in levered bets. So hedge funds got in the business of selling these pension fund managers, all kinds of, you could think of it as get-rich-quick schemes for pumping up the returns on the retirement funds. And if you think about the incentives of the manager of a retirement pool, you have to begin to think about the moral hazard and what's the consequence of failure? It becomes someone else's problem. If I don't have enough money in the fund to pay the retirement, you go off to the Pension Benefit Guarantee Corporation, you have that insurance, or if you're a public sector pension fund, at the end of the day, the liability falls on the taxpayer. So you have this downward protection for the institutional money manager. So yeah, they're going to be aggressive. It's going to be a natural way to go. So let me wrap it up then by saying that quickly, one thought on regulation is we perhaps should shift the focus back and think about reshaping the standards for regulating retirement finance, and that might eat away at the desire to take these levered bets, and then you wouldn't have to be these securities firms wouldn't be so big anymore. Now, that statement is incomplete because the other big bet is in global fixed income markets. The other big bets people are making is on the term structure of interest rates in the United States, currencies across countries. We have less information about what the social gains from that are. Why are people so excited about that? How is that being funded? But I would think in terms of research, if we want to start getting into the details, we think about these basic models and then think about these two activities as really driving the demand for levered bets in securities markets. So if I were to summarize a research agenda for economists, we have lots of models, standard models of banking, where we could say if you regulate banks, it's going to raise the cost of capital for non-financial firms and households. And we would know how to do a quantitative analysis of the cost of that. We have much less of a framework for doing the quantitative analysis of interfering with the allocation of risk or interfering with the ability of agents to act on their differences in information and beliefs in securities markets. This is an important motivations, I think, for this activity that we need to come to grips with. Any theory is going to have to wrestle with the fact, why is this activity small it's sometimes and large in others, and also across countries. Why is this activity small in most countries and large in a handful of countries, particularly New York and London? I shouldn't call them countries, but the financial system centered around New York and London. And then the last question I mentioned in Wellington, as a macroeconomist, you may have noticed I never said anything about causation. I tried to be careful that every time I described events in a crisis, I talked about things all happened at the same time, but not one thing caused another. And so as a cautionary tale, as we think about research, if we go back to the crash of 1929, people at the time were convinced that these financial events on Wall Street were central to the cause of the Great Depression. And then in the early 1960s, Friedman and Schwartz write their Monetary History of the United States, which fleshes out the argument that events on Wall Street were not the driving forces behind the business cycle fluctuations in the United States, and in particular, they were not the driving forces behind the Great Depression. That instead, it was mistakes the Federal Reserve made later with subsequent banking crises that led the money supply to collapse, and that's what did the Great Depression. I'm not here to say that Friedman and Schwartz are correct and that the other analyses were wrong. But I would say Friedman and Schwartz had a very powerful influence on thinking. So macroeconomists such as myself, essentially when we were educated, we did not learn about these links between banks and securities markets at all, because Friedman and Schwartz taught us they weren't central. And so I do wonder whether 10, 20 years from now, people looking back at 2008 might think that Lehman Brothers and the run on repo was actually not such a big deal, that it was a symptom of something else going on, and then some macroeconomist will have some theory of what actually caused the financial crisis. So that's just a cautionary thought. And with that, I'll stop, and thank you very much.